Welcome back to the Real Estate Standard Podcast. This is episode 12 for the week of March 16th, 2026, where commercial real estate and Bitcoin collide. I'm your host, Tim Kotzman. I'm here with Chris, Kenny, and Greg. Each episode here, we break down how serious operators, investors, and developers both stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin. On today's episode, we're going to cover the state of the residential real estate market, including Bitcoin asset utilization loans. But first, I'm going to throw it over to Kenny for an update on Westmain storage stacking.
Thanks, Tim. As of today, March 16th, 2026, our Bitcoin holdings are just under 3.5 Bitcoin at 3.48. That's 348 million Satoshis. So far in 2026, we have stacked 1.3 Bitcoin. Year to date, that gives us a Bitcoin yield of 59%. Our Bitcoin per square foot just crossed the 5,000 Satoshi per square foot threshold, which is exciting. Our Bitcoin holdings now cover 11.3 months of mortgage payments with this recent increase in price over the past few days. Announced earlier this year, but we acquired 2014 shares of Stretch. We received our first digital rent payment from Stretch. We financed that purchase with a loan at 6% non-recourse. That's going to increase our net operating income roughly by 3% a year, just that one purchase, if we don't add any more by the year end. We received the first digital rent payment. And that's like the equivalent for us adding an additional 6.15 10 by 10 storage units. So that's pretty cool. What do you think of that, Chris?
Say that again, 6 10 by 10 units?
Yeah, about 6 and a fraction, 6.15 for the meme. But yeah, it's like showing how you can kind of scale and build out more storage units in cyberspace without expanding your footprint. Traditional operators may have to wait until they have enough cash on the sidelines or are able to borrow a larger amount to go and build a new facility or do an expansion. So we're able to expand as we can find financing and as we capture our traditional rental income.
Yeah, I think, and I think what is underappreciated there is the fact that you don't have any downtime or drag on adding those, virtual units, right? I mean, if you're going to add any number of square footage onto an existing structure, there's a lot of administrative costs that come along with that, and a fairly notable lead time to do all that. So the fact that you're able to add those units, virtually at no cost, is a powerful, is super powerful. What I like in the stacking update here is just hearing some of the statistics and the progress that you're making. Months of mortgage coverage. We were sitting at 8 months for, at least the first 7 or 8 episodes of the pod, right? And in the last 2 or 3 episodes here, we creeped into 8, 9, and now 10. So, whether that's it's a combination of the just stacking sats and DCAing, but also the nominal increase in spot price. That's incredibly exciting. I mean, the reflexivity here that's just kind of percolating under the surface is super exciting. And just wait until you're at 125 again and north of it. It's going to be you as an operator are going to be sitting in a really advantageous position for all the reasons we've talked about on the pod. So I love it. Before I get into, go ahead, Kenny.
Yeah, I was just going to say, you touched on something important there. The difference is it's 100% profit margin with the digital storage units, where physical units, you have to allocate some of that to common area maintenance, hallways and entrances and exits. With digital storage units, you're utilizing everything. You're not letting any space go to waste, essentially. So it's it's um, it's night and day, like the difference, the profit margins.
Yep. Absolutely. Capital efficiency is a reoccurring theme here as we just think about what it means to own and operate commercial real estate in the 21st century. Very, very, very critical. So before we get into some of the current headlines and today's broader topic, I want to give Greg Ranz an opportunity here to introduce yourself and tell cyberspace what you and your team are working on over at Revolution.
Yeah. Hey, everyone. My name is Greg Ranz with Revolution Mortgage. We operate in 48 states. We got 700 employees. We are a traditional residential mortgage lender. And we're trying to build the next generation of mortgage technologies. And for one, that includes a new product we released this year, which is a Bitcoin asset utilization loan. We're one of the only lenders that actually allows people who have self-custody Bitcoin to use that towards income qualification towards a mortgage, which is a pretty big deal. So what people need to understand is that it doesn't require liquidation. You're not holding it as collateral. It is literally used towards income qualification to lower that debt to income ratio to get qualified for a mortgage. That's a big deal for Bitcoiners who have large stacks, who don't necessarily have a stable income stream that they can use towards qualifying for that mortgage. But it's a ever-changing environment that we're keeping up with, like everyone else is. So we keep up with the trends, and we're trying to stay ahead of the curve with the Bitcoin community.
Awesome.
Yeah, Greg, I was excited to learn about your product when we connected offline. Actually, one of our guests, Garrett, who was on, I think, episode 6, introduced us. And when I learned how your product worked, I was actually really intrigued. I don't know if you want to maybe break that down a little bit on how it works. I believe from memory, I'm going from memory here, but you would take the Bitcoin stack and you would take, I think, 65% of it and then divide it by 120 months. And that would give you your monthly income that would be used to qualify for the loan.
You got it. That's it. It just needs to be seasoned for 60 days, wherever it is. And we have methods, whether it be statements on exchanges or custody services like Unchained, where we can meet those underwriting requirements. If you've got it on an umbral node or a stamped seed plate, we have ways to validate that as well, which our underwriters will approve and use towards that qualification. So pretty big deal.
That is excellent. Awesome. That is awesome. I
So
can't wait.
I-
Yeah.
Do you
I
mind
want
if
to jump
drill
into
drill in
I want
with
to
a
jump
few
into a
questions,
couple of
Chris?
the current headlines here real quick, and then we're going to get back into this this overview here. So, a couple big notes, headlines here the last week. Eastdil Secured, a major investment bank in the real estate world, was acquired by Savills. If you're familiar with Savills, they're a brokerage firm. Primarily, they operate across the world, but they're one of their competitive advantages or value adds, if you will, is that they are advising tenants exclusively. So if you think about, you're not familiar with tenant representation, you kind of think about how attorneys represent one side, one party in a court of law. Similar concept here with brokerage and who's representing each party. Savills is representing the tenant or the occupier, the end user of the commercial real estate space. And this is not an isolated merger. There's been a handful of big time mergers over the last year plus, but I wanted to at least highlight this because I think it's just a continuation of a bigger theme that we're seeing and will continue to see across the commercial real estate industry. You kind of look at the revenue streams that Eastdil Secured has as an investment bank doing capital market transactions, and Savills on the brokerage, leasing, and sales side. These larger operators, they need to create additional income streams. They need to diversify their services so that they can not only remain competitive and profitable, but when you find yourself in a market like we have the last couple of years with transaction volumes down 50-60%, they got to be able to keep the lights on in other ways. So you've seen CBRE acquire a number of different types of operations to further their full service platform. And there's a handful of others that have done something similar. So I think this is just a continuation of an existing trend in the marketplace. I don't know if you have any thoughts on that, Kenny.
Yeah, it sounds like consolidation in the space, right? You're going to have businesses that utilize these services, right? If they're going to be needing to lease up space or find new space, that they're going to have to go through a broker, and might as well have that team ready to go, right? I think that's what it comes. I don't know if
they just go. Yeah, you're exactly right. They go into these pitches, and that's part of the pitch at the end of the day. Hey, we'll sell your asset for a slight discount or a haircut on the fee, but in return, we're gonna you're gonna give us the leasing on the back end, and we're gonna offer a one-stop shop for you. So they're serving a particular segment of the marketplace. Highly competitive. Margins have been getting compressed there for, as long as I've been in the business. And I only think you're going to continue to see that. But I think going back to the broader trend here is, you keep playing this out over, the next 5-10 years, you're going to have kind of a two-tiered market. You're going to have the large corporate operators like these guys, and then you're going to have the small boutique regional operators. All the medium-sized shops are getting acquired and absorbed by the larger ones, because that's the only way they can keep up market share.
Well, it's also like a talent acquisition too, right? Where they may have some A players at those companies, and they're like, we really need to get somebody like that on our team to help us just operate better. So yeah, I think they're it's going to give them edge, right? It's going to give them edge against their competitors. There's no doubt about it. And
I would say to some extent there, the reason they acquire these smaller and medium-sized shops is one, talent, but they're trying to gain their market share. But at the end of the day, commercial real estate is still largely relational driven. And when you put things side to side, the small boutique guys are out competing the big guys day in and day out. They're faster to adopt the technology and the tools than the big guys are. There's some major firms, Newmark, they're a publicly traded brokerage firm. There's a couple other, they have blanket policies that their brokers are not allowed to use LLMs, ChatGPT, Gemini, at all. Holy
That's
cow.
Wild. That's wild. It's like banning yourself.
Exactly. Yeah. So, you just, again, you with those things in mind, and you play this out over the next few years, just knowing where this is heading and the pace that it's heading, the little guys are going to run circles around the big guys. So they can acquire, do all the M&A deals they want. But at some point, it's going to be a futile exercise. Okay, let me jump over to another one. I know everyone is going to be surprised by this one, but the latest Fortune 500 to announce they are leaving California is Yamaha.
I'm shocked.
Yes, me too. Me too. That I don't know why anyone would leave California. But no, this is just the latest household name to announce plans to relocate their corporate headquarters. They're going to Georgia, I believe. Again, in a long line of publicly traded Fortune 500 companies. In recent years, I think we've all become really numb to these announcements, unfortunately. But I was doing a little research on this before we jumped on here today, and I was curious to get a list of the names. Right, we have Yamaha today. You got Tesla, Oracle, Chevron, Charles Schwab, Palantir, McKesson, CBRE Group, Hewlett Packard, AECom, SpaceX, Twitter. There's a laundry list of more companies, but I mean, you just look at that's about a little over 3 trillion in corporate market cap value, and about 700,000 employees tied to those companies' headquarter locations. So, take that for what you will, but it's just a continuation of a bigger trend here. And I think what a lot of people, maybe not really think about is these are just the publicly traded guys that are, making these announcements and hitting the wire. There are, and I can tell you from firsthand experience, there is a longer list of private companies, middle market type of operators, 100 million to, $1 billion companies that have done it as well and are continuing to do it. So I don't know how that exactly plays out, if it's good or bad or a nothing burger, but it's just, it is going to leave a much bigger hole in a already, challenging jurisdiction. Last thing I wanted to bring up here today was, and this caught my eye because we've been talking a lot about AI and technology integration, but the city of Santa Ana in California here, Kenny, with us, is banning apartment landlords from using AI pricing software. I'm gonna let that sit there, and I want to get your thoughts because I got a lot on this one as usual.
Yeah. Well, first off, I can't imagine how they're going to find out if you're using the software or not anyway. Like how, like it's a little bit overreaching. Like, what are you gonna, you want to, like look into the management software that these operators are going to use? That's just ridiculous. I didn't even know that they could. How do they even enforce this? Like, what's the penalty? I mean, it's just so crazy.
$1,000 per violation. But to your question, how are they going to enforce it? I'm not sure. I mean, maybe if it's consumer facing on the website, that's where they get you. But I agree with you. Where they're going to go to each knock on these landlords' door and say, let us see behind the curtain on how your pricing structure and how you view fair market rents.
I mean, how do you determine what's AI and what's not? Like AI stands for artificial intelligence, right? Like we've been using lower forms of AI and software for decades. Are you just saying we can't use software anymore? Like
You
like,
can't
You
even
need a signed lease from all the neighbors, and then you have to do it on a typewriter calculator.
Kenny, I think the next thing is you can't use a calculator.
Right. Yeah. I mean, that's like the first like kind of form of AI, right? Like automating math. Just and I mean, in school, when we were going to school, or when I was going to school, grade school, they wouldn't let you use calculators and like stuff like that. I think that's kind of changed. I don't have kids yet, so I'm not sure, but like I'm pretty sure that like you have like the Texas Instrument calculators that were embraced at some point for complex math equations, and
The TI-84.
it's like, are you gonna yeah, like Tim said, are you gonna ban these operators from using calculators? And I mean, this is kind of giving more reason to like leave states like California, even though that this is Santa Ana, like the county doing it. It just seems so overreaching, out of date, and it's just like I imagine how they're going to enforce it is through like some kind of class action lawyers that they find a lead plaintiff, they go fishing for tenants in your building. Hey, give us a copy of your invoices, and they look up the company if there's any like company on the footer of the invoice.
They'll get some,
Producing.
yeah, you're probably right. They'll get some kind of ambulance chaser to go file some frivolous, shakedown lawsuit. But the enforcement aside, I mean, what we're talking about here is it's not going to go away. There's definitely a political motivation here, but it comes back to the elected officials having a scapegoat for the cost of living, right? I mean, that was actually quoted in the article of why they were doing this or even considering it is there's an issue with the cost of housing. This is one way that we're going to combat that. Whether that makes sense or not, we won't get into that.
Doesn't AI make it cheaper though? Like, isn't that going to automate a lot of these like delinquency calls and letters and texting reminders and all that type of stuff is going to make it more efficient so they can potentially offer cheaper rent or more amenities or better service. So it's like
I
counterintuitive.
I agree with you. If I was, that's the tact I would argue is, this is going to be, up to the second dynamic pricing models where, you're going to be able to adjust in real time, based off the number of units available, how long they've been available, the various pros and cons of the property or of the unit. You can actually get, really, really granular with how you price these. And, at the end of the day, it's a benefit for the marketplace. But, I guess to each their own as far as how they look at that. But I think the bigger piece of this here is, this is one of, many conversations that the business community, not just the real estate community, but the business community is going to have about AI. Right? It's like, okay, whether it's housing affordability issues and it's AI's fault, or it's job losses and I can't get a new job and it's AI's fault. I think we're in the very, very beginning innings of this saga, and I think as it accelerates, the elected officials are just going to it's going to be their default. Right? It's AI's fault. We need to legislate AI. We need to, legislate the uses and the practicality of it. It was the cities in California that have already taken similar actions. You're not going to surprise you. Your company is basically San Francisco, San Diego, and Berkeley. If that tells you anything there, but I don't think the list is going to stop there. I think it's going to continue, at least for the foreseeable future.
Yeah, it's like I'm thinking like it's like rent control, but now it's like cost control, like expense control, right? Like they want to like keep your expenses fixed, maybe because they have investments. Maybe it's back to what you said about these boutique real estate investors and different markets that are able to run circles around these bigger, clunkier, older companies, right? That are larger, they have more assets, but they may have like the ownership may be just like an older manager or syndicator kind of thing, and they're just not up to date. But like, can you imagine? Like it's like, oh, you can't have a website or you can't have an internet connection at your building. Like there's been a lot of people
Illegal.
that have
Illegal.
there's been a lot of people that think that have come out and said that AI is like intelligence will be like on a meter, just like electricity, water, or any other utility, right? Like AI intelligence is going to be a utility, and you're trying to block that. Like it's like saying no natural gas or no electricity or no power for your building. You have to remain in the Stone Age.
They're
And
doing that here too. In Colorado, we just passed a law. No, new builds are not allowed to have natural gas lines. So I mean, there's just different flavors of it all over the place.
Yeah, that's
is that the main heating in Colorado? Is it mostly
For older
natural
homes,
gas?
yeah. I mean, I have a nat gas generator and a nat gas connection, but new builds are
So
supposed
what
to be
are they
all
pushing?
electrical.
What are they
Electrical.
pushing?
Great.
Electric. Yeah.
Yep.
Greg. That's a good transition point. Let's. I want to hear a little bit more about Revolution Mortgage and what you guys are doing in this space.
Yeah. So I mean, I'll start with the market, right? The market's changing, right? There's a ton of FUD out there, fear, uncertainty, and doubt. We see the numbers of real estate agents that only have 2 or 3 deals over the last couple of years. Lots of loan officers are exiting the industry. The rates are high. Government keeps printing, so asset prices are through the roof. It's kind of a tough market in Colorado, but we got to adapt with the market, right? So we're looking at it from a perspective of the age of a first-time home buyer is going up. The median age of all home buyers is up to now, I believe it's 58 per the Apollo Group. So when you look at that, as well as the boomers who are age 62 to 80 now, they're in a transitional period, and frankly, they own a significant majority of residential real estate that's out there, right? They were in the sweet spot where in the 70s and the 80s, houses were $50,000. Now they're worth $1.2 million, right? It's crazy. But we're taking it from our businesses sort of transitioning to, we're not just a future home finder for the average person, but we're a transition guide. As these people age out and they start handing this equity to their heirs, if they have them, we're going to need to be there both to transition them from these larger properties into something that makes sense as they need to go into, say, a ranch house or a tiny house or assisted living, that sort of thing, as well as estate planning to get it into their kids' stuff. So there's going to be a lot more business coming from life transitions, not just the traditional home search, which means the inventory is going to rise, but unevenly, because you've still got a younger age class that are going to need to be given more guidance and have more creativity to get into a home as opposed to renting, right? It's just unfortunate government keeps printing. And if you know about the Cantillon effect, all of those are going into assets and pumping up those prices. So as long as rates remain where they are, if you look at the average mortgage for a house that was, $250,000 5 years ago, that was a $1,600 a month payment. That same house right now is worth $500,000 to $600,000 and requires a $3,500 a month payment. It's pricing a lot of people out of the market, particularly if they're saddled with a bunch of student debt, or some delinquencies because of just not managing their finances. So senior real estate is going to become a bigger lane. And then, we will need more guidance and creativity like the Bitcoin asset utilization loan for millennials who have been stacking, but, haven't made the transition. So we're going back to education about, what is the cost to rent, right? You're going to build a significant amount of equity just getting into a home, maybe not your dream home, but it beats paying someone else's mortgage through renting. So But I'm finding a lot of realtors who are tremendously busy. I worked with a lady yesterday. I'm now helping them do a HECM, which is a home equity conversion mortgage. It used to be known as a reverse mortgage. For someone who wants to transition out of a house and use the equity that they have, pay off their mortgage, and throw that into a new purchase to downsize a little bit, even though it's a more expensive house. But
Gotcha.
she closed 15 deals last month, which is wonderful. And there are a lot of agents that are extremely busy, but it's about adapting to the market right now.
Yeah, we've chatted with a couple other groups and folks that are operating in this space that you're in here, the residential lending world, and it seems like everybody's got a similar type of approach, but each of them have a tweak or two that make them different and unique. What is this? Can you explain to us what this Bitcoin utilization loan is, how it works, the mechanisms that make it what it is?
Yeah, so it's in our non-QM, which is a non-qualified mortgage, which simply means it's not going to get picked up by Fannie and Freddie. It's private investment. So the rates are a little bit higher. But we do these for all sorts of scenarios. You can have a 401k account. Those have similar models, right? Where it's for a 401k, I believe it's 75% amortized over 240. So it's actually worse than a Bitcoin asset utilization loan. But there are some people who need access to cash. They have equity. They want to do something like a cash out refi. And but they're not working, or they are on Social Security and they don't have a tremendous amount of income to qualify for such a large mortgage. We can get them qualified through this program by going to one of our private investors to get qualified for this mortgage.
Okay, so that was my next question. Was the capital behind these deals is coming from, sounds like, the private space?
So we have investors at Revolution Mortgage. We do all of the underwriting and processing. We do it from start to finish. We have access to other programs outside of our brokerage, but this one, we have a bunch of investors who are supporting this product.
So I wanted to ask you a few more questions about this product, because we talked offline about a month ago when we were scheduling you for today. And you mentioned that I believe that there was no callable, like there's no margin call as far as Bitcoin price goes. Once you're qualified, that's it. Like you're just using it for income qualification. And you could actually decide if you wanted to, after you're approved, you could sell the Bitcoin, and there's nothing wrong with that, right?
100%. Yeah, we do not lock it up as collateral. So we're looking for the 60-day seasoning, and we're going to take the most current or an average of the two fiat values based on those 60 days. Use that towards qualifying income, and then you're free to do whatever you want with your Bitcoin. We don't lock it up. We don't hold it in collateral. Once the loan is closed and you've been funded, we don't care.
And you mentioned, so when you say 60 days season, that means you have to own the Bitcoin for 60 days, a minimum of 60 days.
Correct.
And, it sounds great, but you're still going to divide that by 120 months, right? So does the duration of how long you've owned the Bitcoin, whether you've owned it for 4 years or for 4 months, matter?
No, it's only going to matter based on the fiat value when we're doing the validation, primarily. Or
That's
what's
pretty
on
attractive. I mean, like it's very,
It really is.
low risk to use your Bitcoin in that way, because you're just using it for qualifying your income, and that's it. And it's 60 days. So like if you're, if you're just doing it for a short period, and is there any other assets that you'll do that with?
I mean, we do it with brokerage accounts. We do it with 401ks, IRAs, traditional finance accounts. Absolutely. Those
So
have been around
you
for
would
years. It's
you would
just,
use something like a Stretch or the digital credit products. You'd use that dividend income and the underlying asset itself.
yep. I just did one with someone who had $200,000 worth of MetaPlanet. Use that towards
That's
income
pretty interesting.
qualification on a similar trajectory, right? You take the value of that stock, amortize it over 120 months because it was in a, non-retirement account. We can do a little bit better on the numbers behind it. But yeah, use towards income qualification for a cash out refinance on a Texas property.
Wow.
We talked, Chris, Tim, and I. We talked, when we started this podcast, whether we should have residential Bitcoin companies come onto the show and onto the podcast because we're predominantly fixed on commercial real estate. But what we decided was to have folks like you on, Greg, was because we think the residential products are going to come to market first. It's a larger TAM. It's a different. Sorry, I just looks like I dropped for a second. Can you guys hear me?
Yep, you're there.
We can hear you.
Sorry. So it's kind of the precursor to commercial. We're going to see the residential products come first, and then eventually we'll see the commercial products. So, interested to know, what do you guys have plans to offer commercial products, or is this something on the roadmap?
Not at Revolution Mortgage, right? And just so I'm clear, this is just the first step, right? We see what Pulte's doing, pushing Fannie and Freddie, who are the major funders of the traditional qualified mortgages, to treat Bitcoin as the asset that it is, right? But we also do tax statement loans, right? Where I can take tax statements for 2 years and look at the income from that and use that as qualification for a loan, except if it's the sale of Bitcoin and it's all on your taxes. I've had a few of those that we had to shut down. Those are the things that we're waiting for Pulte to fix. I'm also trying to find title companies who have brave lawyers who will talk me through, how do I pay a real estate agent in Bitcoin through a residential real estate transaction? How do I do a buyer buying a residential real estate property by giving their Bitcoin to a potential seller, right? And my thought is that there used to be bartering transactions, right? I want this piece of property. I've got 10 cows and a tractor. I want to trade for it. Well, those sorts of deals have happened in history. Swap out the cows and a tractor for Bitcoin. My buyer has it. My seller wants it. How do we make this happen? So slowly asking those questions and putting them in front of people. But when you get to title companies and the processes between county to county, it varies so greatly from county to county and state to state. It's mind-boggling. There are still counties that are working exclusively in paper. Many have gone digital, but the processes vary from company to company, county to county, state to state.
I think this is really interesting because I was having a conversation recently with a friend of mine who's in the residential space, and she is not up and up on Bitcoin at all, right? So she was asking some questions, and this was, it was earlier in the year, and I had mentioned to her that the administration was, moving in the direction of allowing Bitcoin and certain crypto holdings to be accounted for in the qualification process, right? Which is what you're talking about, Greg. And now that is a real option, or as it becomes more widely known and ultimately used, it'll be really interesting to see how the millennials in particular utilize that. And what I mean by that is the millennials have postponed kids, family formation, buying their homes, right? They're in their late 30s, early 40s now. And all of us, maybe they've been stacking Bitcoin for this whole time. That was their store of value mechanism. And they haven't been able to utilize it until now. In that scenario where I can go to you and say, hey, Greg, here's a stack of cold storage Bitcoin, right? It's got that 60-day season box checked, right? In that scenario, do I forego the starter home altogether and go right into that, second tier mid-level home that, maybe my wife or kids need or want? I think it'll be really interesting to see how the demand in the marketplace plays out because of this whole conversation we're having here. Does Bitcoin not only allow you to get that house and do the family formation that we've always wanted, but does it also allow you to catch up? Right? I mean, I think that'll be really interesting to see unfold.
I don't know if it allows them. I mean, eventually, yes, I believe it's going to allow them to catch up. Does it allow them to skip a step? Probably not, given the inflation of asset prices and the rates where they're at currently, right? Because it's all coming down to that monthly payment. What can they comfortably afford to get into a mortgage? And most of the people say, well, it's my rent payment, which is often a lot lower to get into a home, especially if they want to go straight to the 4-bedroom 25 to 4,000 square foot home, right? That's going to be a pricey home these days. So the expectations of some millennials are, well, I might as well just keep renting, but they don't realize they're just paying someone else's mortgage and blowing that money when they could be building equity, even on something that isn't their end goal. But building equity is building equity. With asset prices inflating, I should say a good amount of residential real estate is still inflating at between 3 and 6% per year, which is huge from a investment perspective. That allows for refinances down the road when that asset price continues to go up. And there's no signs of that stopping, given a catastrophic residential real estate scenario, or the government stops printing money.
Yeah.
So my bet's on they continue printing money, asset values continue to go up. There's going to be certain markets that struggle, but things I saw years ago, I was at an open house for a house built in the 70s that was going for 1.8 million and nothing was updated in it, and it will sell.
Yeah.
So it's about communities and areas that are hot with good schools and good communities. And
I want
Hey, Greg.
I want to put you on the spot here a little bit, Greg, and I want you to put some numbers to this. Help the viewers here quantify what we're talking about here. So, let's just say you got a $1 million home, right? Round numbers, $1 million home, good neighborhood, good market, it's in good condition. What if someone is interested in using this product, right? What can they expect as far as down payment, LTV, interest rate? Like, give us the 30,000 foot view, so they can put down some napkin math here and try to understand what this option looks like for him or her.
So for the Bitcoin one, you're going to need at least 20% down, right?
Okay.
Let's get that out of the way. So 200,000. Loan amounts are going to be 150,000 to 2 million currently. That is our sort of range that we support. And then rates are probably between 7.8 and 9%, which is quite competitive for a non-QM product. But that obviously is going to vary about the loan to value, your debt to income, your credit score, and all your qualifying principles, right?
Okay.
I have another question that popped in about the qualification process with the Bitcoin, and I guess that would be what I think you answered this last time, but I'm not sure, so I'm just going to ask it again. How do you come up with like the price of Bitcoin? Bitcoin's volatile; it moves up and down. So if you're going to get a pre-qualification letter, and you know at the time of looking at the house, Bitcoin's at 74,000 today or whatever it's at today, and it fluctuates. Maybe by the time of closing, say it goes down and we're at 69,000.
Yeah. So I we're going to be using the statements from wherever it's being custodied. If you're on a self-custody situation, I personally am going to just take what you tell me and pick it off right where we're at, use that towards the prequal. And then as we get closer, once we need to do that validation, we will see. But I would hope that even though Bitcoin is volatile, it's not going to impact that math significantly, right?
So are you saying that it ultimately will, like, the price will be the day of the closing, like
No, I'm saying it'll be, I will use whatever it is that day once I see the application, and then we will ultimately use it once we do the actual validation.
So you'll use the number at the time of mortgage qualification,
Correct.
regardless if it's up or down?
Correct. Yeah.
Yep.
So I
Okay,
gotta,
so
just because we're on this topic, I gotta kind of play a little devil's advocate here. I don't want to be accused of too many softball questions, but I'd be remiss if I didn't bring up the private credit drama that's going on at least on X, and most financial outlets the last couple of weeks. And I know that's a very broad area of the markets. I mean, the private credit space is made up of not only real estate loans, but a number of other types of loans, auto sector credit, payday loans, all that type of stuff. While this sounds good, I mean, where does this whole model fall in that private credit conversation? And are the underwriting requirements getting too lax?
That is a fantastic question. So yes, we're going to have to go through this process a few times and start to educate this industry. There is a lack of will to educate the processors, the underwriters, even the investors who are funding these things to a point, because they have to put in the work, right? Where there's no proof of work here. It is, we hear this is now an asset. We need to get in on that. Here's our risk tolerance based on the requirements. Go forth. But they don't want to put in the work to do the education to, really dig in and fix this. So I think once we get a few of these through the hopper, there's going to either be a desire to start learning or a desire to increase the requirements for qualification because of that fear and lack of education, right?
Mm-hmm.
sounds like we need
unfortunately,
the
there's
real
just-
estate standard educational course to get your accreditation.
Well, and it's funny because when this first came out, I was asking our VP of non-QM, hey, I have so many questions for processing and underwriting, like on the self-custody side, are we going to require NPUBs? How do you do this when you've got 15 addresses that make up, a cumulative, balance for the node and all of these different questions. And they said, basically, you can't ask processing and underwriting that. They're going to look at you with glazed eyes. Just we'll get you the requirements doc and you can go from there.
Well, I was going to ask you too. So you said that you can use your own self custody, and you're gonna just you're gonna have, like, I'm assuming, right? Like I'm just trying to, like, you tell me where I'm wrong, but you're gonna have somebody share their public address with you.
Nope,
Um,
don't even need it.
are you gonna look? You're gonna look on chain to validate that the Bitcoin's there, and like you're not gonna have them sign a message with the with.
We are going to have them sign a message, yes, and we are going to validate the.
So are you gonna need the XPub, or are you gonna
Nope.
just?
It is going to be essentially a Teams meetings with screenshots and time and date stamps from the borrower's computer.
But what,
And
like, oh, so you're gonna have them sign a message though,
we are going to have them send a small amount of Bitcoin to a KYC
from that
account
address.
from that address.
Now, what if it's in multiple addresses? Are you gonna have them send a small amount to from all those addresses?
No, doesn't matter if we can see the whole balance from the note.
I guess, like, what's like preventing me from showing you Satoshi's address and say, yeah, like, let me buy this mansion over here. Like, I can show you a few addresses, and I'll sign with one of them, and then the other ones will be. I don't mean to put you on the spot or anything. I'm just like, I'm genuinely curious about this.
I am too. I think it's good that we have this conversation because it's not this isn't a one-off, right? I mean, I think there's inertia across the entire industry, residential and commercial, collectively. So, and unfortunately, most people don't want to, have the uncomfortable conversation. So I'm glad we're doing it. And I think the education piece, like you said, is critical. There's going to be winners and losers, at the same time.
So we're going to have that initial balance from the application process through the loan officer, myself, communicating with the potential borrower, right? Or it will be a pre-made transaction or a conversation for, hey, I need to know how much Bitcoin I need to have on a particular node so that I can get qualified for this much income to get qualified for the full mortgage that I'm looking for, right? So I'm planning to work with those borrowers to determine what that Bitcoin stack number is. So if the guy's got 1,000 and he doesn't want to dox himself on his personal node, we'll figure out what he needs to get to qualify for that $2 million mortgage, right? Once that's established, we will need them to set up a KYC account somewhere where we will determine, and then I would meet with this borrower, have them show the self-custody node, and we will pull screen caps from their node and send a small amount to their KYC account, showing that on both sides. And that is the requirements and what we would use for the underwriting process and validation process.
And I'm sure that's going to be like, you're going to iterate, like, as you guys originate these loans, you'll dial it in better and better, but you got to start somewhere. And I mean, the fact that you guys are willing to do this, I mean, it's, like a risk that you guys have thought through and are willing to take. I think this is perfect for the Bitcoiner who bought Bitcoin 10 years ago, doesn't want to sell any Bitcoin, doesn't own a home, wants to, settle down, start a family, like you said, just kind of, build equity in a home they've been renting, and that's not doing anything for them. So I think this product has legs, and I haven't seen anything quite like it. I think it's different than the other products that we've seen, and some of the other guests that we've had on our show. And so I think that this will do well.
Is there a like when you're assigning risk, right? Are you going to assign the long-term hodler, the low time preference, DCA, or a lower risk profile than someone that heard about the product and bought some sats 61 days ago? Like how do you guys kind of think through that internally?
I mean, ultimately, it comes down to the math that they are allowing us to utilize for income qualification, right? Like that's where the risk profile is built in. 80% LTV, the loan amount ranges, the percent of the verified Bitcoin value, the amortization behind it, right? Like that's where this risk is built into the loan. So as long as they can prove that out, it doesn't really matter much. And then back to the self-custody validation, if you Google Satoshi test, that is sort of the foundation behind what that validation looks like. Similar to, you link a credit card to a bank account, we're going to send two small amounts to your bank account, come back and validate, how many cents we sent to your savings or checkings account or whatever, right?
Yeah.
I'm not a fan of putting stuff on the blockchain, but that would actually be a financial transaction if you're doing these, small UTXOs, like, hey, move some dust over here in these amounts, right? Like you can get rid of your small UTXOs in a meaningful kind of transaction. And then, you can have an opportune message in that transaction, verification for account number 034, whatever.
I would love to get to that point where we're asking for, loan numbers to be put in op returns, but we're not there yet. No.
Awesome. Anything else before we wrap up here?
I just think it's interesting. I just sent you guys the message. The SEC is preparing a proposal to eliminate quarterly reporting requirements for companies, according to the Wall Street Journal. So I don't know if that means you're going from quarterly reports to annual reports. And then, Jeff Walton commented, it bodes well for digital credit and digital equity. Risk being calculated 24/7, 365 will be preferable to computers and algorithms that are trading this stuff. So not exactly on the residential real estate topic, but I think it's going to be interesting how things continue to develop, both from a regulatory and a tech lens. And it just seems to kind of be accelerating the bewilderment, if you will. Kenny? Any thoughts?
Yeah. That's interesting. Yeah. Did they specify whether it would be more frequent reporting? I'm assuming that's what it would be in favor of than less frequent, right? Because things are moving so much faster, or are they just are earning reports dead?
No, my understanding is it's less frequent. I don't know if it's twice a year or just an annual reporting, but I have not seen anything that's higher frequency than quarterly. But that's whether it is twice a year or once a year. I think it's it's definitely beneficial. There's no reason everybody's got to get all hot and bothered over quarterly reportings. It's a waste of time. There's not enough that happens in that time space. Let people focus on operating the business and executing the strategy, and report once or twice a year to help them cut costs too.
Absolutely. Greg, before we wrap up, is there anywhere that people can reach out to you to have a conversation?
Yeah, absolutely. I'm at BTC Mortgage Guy on X, and you can always hit me up at granz@revolutionmortgage.com. Shoot me an email. Would love to connect.
Great
Awesome.
handle, by the way.
Great handle. All right. Chris, Kenny, any additional closing thoughts, or I'll outro us here?
Close us up. Appreciate you making time, Greg.
Yeah.
Thanks, guys. Appreciate you.
Yeah. All right. Well, that's it for today's episode. If this conversation was useful, please share it with a partner, a client, somebody making decisions in the marketplace. New episodes drop weekly, both the live here on social media and on our YouTube channel. Just search The Real Estate Standard on YouTube. And until next time, stay disciplined, think long-term, and stack sats. This is The Real Estate Standard.